Bismillahirrahmanirrahim. Assalamu alaikum everyone. My name is Yasir Yamin and I welcome you all in this financial reporting session. My friends, in today's class, we'll be discussing one question which is based on consolidated financial statements. In particular, we'll be discussing the preparation of consolidated statement of financial position. And this is a question in which you will see a bit something different. For example, in this question, you will be seeing two subsidiaries rather than only one, like the traditional consolidated SOFP questions that you used to witness. Now, it's an easy question. I won't say it's too difficult, but again, you need to be at your 100%. So make sure that you perform very well. Yeah. So let us look at this question. Examiner says, Dobry company purchased its 80% shareholding in Kroll company for cash 5 years ago when Kroll's company retained earnings were $30,000 and the balance on its revaluation surplus was $15,000. So here we see if we start making up the solution, we already know that first of all your examiner talks about one subsidiary which is Kroll company. You acquired this Kroll company 5 years ago, so it's an old acquisition, yeah. And at the date of acquisition, your pre-acquisition retained earnings were $30,000, whereas your revaluation surplus was $15,000. Now, my friends, you can call these as pre-acquisition reserves. Pre-acquisition reserves. You guys do remember how important pre-acquisition reserves were to us. More specifically, in a consolidated SOFP question, these are very important to us because we are going to use them while we prepare our working for goodwill and also retain earnings. Yeah. Moving forward, our examiner also says to us that there is Hens company. Hens company had retained earnings of $16,000 when Dobry company acquired its 75% shareholding for cash of $100,000. So here we are basically talking about two companies. We have one subsidiary in which we have holding of 80%. Yeah, holding of 80%. We acquired this company, Kroll company, 5 years ago, and these were the pre-acquisition retained earnings. Then examiner talked about Hens company, which we acquired on 1st of January 2006. Note that our year end is 31st December 2006, as we can see from the requirement, and also we can see from the summarized statement of financial position, the data given. So this year's accounting year end is 31st December 2006, whereas we acquired this Hens company on 1st of January 2006, which is the start of this year. And examiner says we acquired 75% shareholding. That means we have a holding of 75%. Now I'm just making up some data on my spreadsheet so that I ensure that I do not forget anything. That's the whole idea. As long as you are reading the question, make sure you are well versed with the fact that you need to note down specific indicators, or you need to note down special facts that you identify into the question. Yeah. So examiner says again, Hens company had retained earnings of $16,000 when Dobry company acquired 75% shareholding for cash of $100,000. So again, I can write it down. The pre-acquisition retained earning was $16,000, and this becomes part of pre-acquisition reserves. Yeah. So if I were to really ask you that what becomes part of pre-acquisition reserves of your subsidiary. Now, pre-acquisition reserves primarily means that you're talking about the net assets that were available at the date of acquisition. Now, when you talk about net assets, you mean assets minus liabilities. And when you say asset minus liabilities, you mean equity. And when you talk about equity, you are talking about pre-acquisition equity, which should include pre-acquisition share capital and should also include all reserves. Now, my friends, for Kroll company, we figured out that we have two pre-acquisition reserves, which included retained earnings and revaluation surplus. For Hens company, we have one given pre-acquisition reserve of retained earning of 16,000. But you see, equity includes share capital and reserves. So there must be share capital, pre-acquisition share capital of both companies as well. If I were to find out share capital of Kroll company pre-acquisition and share capital of Hens company pre-acquisition, where do I get this data? Remember I told you while we were practicing in our, basic queries and basic questions. Share capital in our cases in FR paper, we know that share capital of S company does not change post acquisition. So whatever share capital you have at the balance sheet date, it's presumed that it would have been the same share capital at the pre-acquisition date as well. Now here your examiner has not mentioned about share capital. So where do you go and find out share capital of S company at the acquisition date? You just go and see the balance sheet of Kroll company and Hens company given to you. And you can easily see that the share capital of Kroll company and Hens company is easily provided at $100,000. If at the balance sheet the share capital is 100 and 100, it would have been the same at the pre-acquisition date as well. So I can easily write that share capital would have been 100,000 for Kroll company and 100,000 same, for Hens company. Easily done. But let us read the whole paragraph. Hens company had retained earnings of $16,000 when Dobry company acquired its 75% shareholding for cash of $100,000 on 1st January, with a further cash payment of 87,200 deferred until 1st January X7, which is 1 year from the date of acquisition. So for the purpose of Hens company, guys, for the purpose of Hens company, we have two types of consideration, that had been paid to acquire 75% of their share capital. Two types of consideration we are talking about. One was cash consideration, which is 100,000 in itself. And then there is 87,200 deferred consideration for a period of 1 year. So if I were to calculate goodwill of Hens company, calculate goodwill of Hens company, at least the consideration I can calculate right now. The consideration part I can calculate right now. Yeah. And that would have included two types of consideration. One would have been cash and the other one would have been deferred. Cash consideration, examiner has already mentioned that cash consideration was, I'm sorry, what was it? Yeah, it was $100,000. So I can easily write here, cash 100,000. Okay. But what about deferred consideration? Now, deferred consideration was given 87,200, but this is to be paid 1 year after. So we need to calculate present value of this. So if you go and check out, examiner is saying no accounting entries have been made in respect of the deferred cash consideration. So no accounting entries have been made by the examiner. That means we need to perform it. Dobry company has a cost of capital of 9%. So you need to apply a cost of capital of 9%. So 1 divided by 1 plus 0.09 raised to the power 1. This should have been the, formula that we should have applied. Yeah. Agreed? So if I now go and apply this formula, yeah, I would get a present value of $80,000, and the present value formula is written in front of you just for the sake of it. Okay, so you calculate present value of 87,200 and you will get a value of 80,000, which is the present value of deferred consideration. So how would you be accounting for deferred consideration, by the way? Now, first you need to calculate the present value of deferred consideration and make an accounting entry, investment debit and deferred consideration liability, deferred liability credit of 80,000. First, your accounting entry is going to be this. Is there anything else that you need to do here, my friends? Is there anything else that you would need to do here? I can maybe take this much place as well and I can write down this entry here. Yeah. This is the first entry of investment. Anything else that we need to do? We need to do unwinding of discount. Yes. It is our purchase, our consideration, it will be our expense. Yeah. So we need to perform unwinding of discount at the rate of 9%. We acquired this company. We acquired this company for a present value of $80,000 and we'll be applying 9% unwinding impact on it. And that would equal to 7,200 maybe. The accounting entry would be CR or consolidated retained earnings debit. I can write down for you as consolidated retained earning debit 7,200 and deferred consideration liability credit 7,200. This would have been our accounting entry. Do you guys agree? All good? Done? So this is what you do for the purpose of, for the purpose of preparing consolidated SOFP. Done? So going back to the question, now we have read this much part here and now we need to follow the question. Your examiner says the following are the summarized statement of financial position of the companies as at 31st of December X6. Note down the fact that your year end is 31st December 20X6. Now you have been given the summarized statement of financial position of three companies. First of all, you have been given SOFP of Dobry company. Dobry company is the parent company in this question. So this is your company. And then you have been given two subsidiary SOFPs, one for Kroll company and the other one for Hens company. For each of the three companies, you have been given property, plant and equipment. And while you are preparing consolidated SOFP, you would be consolidating as if you own everything. So everything's yours. You need to just consolidate. Yeah. Then you have been given investments or, in Kroll company and Hens company. Investment with a value of 180,000 in Hens company and investment with the value of $100,000 in Hens company. Now you can closely see that this investment that your examiner mentions about Hens company, this only includes cash consideration of 100,000. Your examiner had not recorded deferred consideration since the beginning. So it does not include the impact of 87,200 which we recorded through this accounting entry that we prepared. All right. So nothing related to deferred consideration was actually recorded. We did this by making an accounting entry. But all of you guys know that we follow, cancellation of like items rule. So we know that investment of parent company and equity, pre-acquisition equity of S company is always eliminated. So you'll be cancelling off 180, 100 from here and cancelling off 100, 100 from there from the balance sheets of S company. So this comes into cancellation of like items. Moving on, you have current assets of 526,000 for Dobry company, 170 for Kroll company, Hens company you have $80,000. So current assets have been provided to you. Okay. Moving on, you have been given share capital of parent company only. Remember, share capital of subsidiary companies is knocked off, is eliminated just because you follow the cancellation of like items rule. So you will only get the share capital of parent company here, 500,000. Then you have been given revaluation surplus of Kroll company at the balance sheet date of 30,000 and retained earnings of each of the three companies at the balance sheet date. This will enable you to prepare consolidated retained earnings or consolidated revaluation surplus as you move forward. All right. Then you have been given current liabilities of each of the three companies. This will enable us to prepare a consolidated SOFP. Moving on. Now, in note number 1, your examiner provides you the fact that at the date of acquisition, the fair value of Kroll company's net assets were equal to their carrying amounts. So there was no fair value adjustment. You can easily calculate goodwill if you want to. I mean, if I were to do it, I can do it right now. I'll just write goodwill of Kroll company and I can just calculate goodwill as it is. Yeah. So first of all, I will take consideration. This company was acquired in terms of cash. And if I go up, it was clearly written, it was acquired for cash 5 years ago and the cash paid would have been 180,000. So cash here comes as 180,000. Done. Sir, first of all, if you're calculating goodwill, we need to know if it's the full goodwill method or the proportionate goodwill method. Yeah. So if you come with me and you look at last note, note number 5, I want you to look at. Note number 5, please. So it says Dobry company measures goodwill and non-controlling interest using the fair value method for Kroll company and the proportionate method for Hens company. So for at the very least for Kroll company, you need to follow the full goodwill method. And under full goodwill method, you always take complete consideration against complete net assets. Examiner says the fair value of non-controlling interest of Kroll company at the date of acquisition was 39,000. So if I were to write fair value of NCI at acquisition, this would be, guys, this would be 39,000. So the total consideration you would be having is 180,000 plus 39,000. 180,000 plus 190,000. All good? Done? Here we also write less fair value of net assets of S company at the date of acquisition. Yeah. So what comes in fair value of net assets of S company at the date of acquisition? You take pre-acquisition reserves. And remember, we already figured out what were the pre-acquisition reserves for each of the companies at the acquisition date. We already did that. Now we have 3 pre-acquisition reserves given. 3 pre-acquisition reserves. I would write share capital, retained earnings, and revaluation surplus. So share capital had a value of 100,000, retained earnings had a value of 30,000, and revaluation surplus had a value of 15,000. Yeah. So I can just post this here. If I were to complete this, we were taking complete consideration above as per full goodwill method. We will take complete net assets here. Yeah. So is equals to sum with a minus, and then you will get goodwill of Kroll company as 180 plus 39, netting it off with 145,000 total, you will get a goodwill of Kroll company of 74,000. We got one thing at the very least. You have goodwill of Kroll company of 74,000. Yeah. So no fair value adjustments here. Examiner already told us that. We'll move to note number 2, by the way. In note number 2, your examiner says at the date of acquisition, the fair value of Hens company's net assets was equal to their carrying amount, with the exception of some plant whose fair value was 24,000 greater than its carrying amount. So basically, there was an upward fair value adjustment. I can write down note number 2 here. And there was an upward fair value adjustment, if you guys can follow. So it was a fair value adjustment above of 24,000. What would be the accounting entry for this? Plant debit 24,000 and goodwill credit. You know now, whatever impacts come on pre-acquisition date, it always impacts the goodwill. So 24,000 credit. This is how you do it. Yeah. So plant debit, goodwill credit, this is the first adjustment. And examiner also said at this date, the plant had a remaining useful life of 4 years. Remember guys, plant is basically a depreciating asset. Therefore, you would need to recognize some sort of excess depreciation on it. So 24,000 divided by 4 years, that would mean a per annum depreciation, excess depreciation on, Hens company's assets of 6,000. All right. All good, my friends. So this is excess depreciation of 6,000. The accounting entry could have been, CR debit 6,000 and plant credit 6,000. I don't know why I had written, only CR debit. It is the asset of S company. So CR debit, NCI debit, 6,000 will be shared between the two. 6,000 will be shared between the two. And this is how you go for it. Yeah. This is the accounting entry. Done. CR and NCI both will share here 80%, or what was it? Yeah, 75% only. So 75% goes into CR, whereas 25% goes into NCI. All right, this should have been the accounting entry. Okay, done. Now we have done fair value adjustment. Can we calculate goodwill, by the way? Can we calculate goodwill for Hens company? I think we can. So for this, remember guys, examiner told us that Dobry company has the policy to follow proportionate method for Hens company. So that means you are going to calculate goodwill in a different manner altogether. Yeah. So I can just write this. I will write fair value of net assets of S company. Yeah. And in this fair value of net assets of S company, you will have share capital of Hens company, then retain earnings of Hens company. Remember, we had already determined share capital and retain earnings, the pre-acquisition balances. So share capital was 100,000, retain earnings, pre-acquisition retain earnings was 16,000, and there was also an upward fair value adjustment which was 24,000. So all in all guys, the overall net assets, I'll put it with a minus sign, is equals to sum minus sum. It will come as 140,000. But we won't take 140,000 in totality. Remember, this is the proportionate method. So if you're following the proportionate method, you only take the proportion of your net assets that you'll be comparing with your consideration. So I would be taking only 75% of it, which is 1050000. 1050000. So what is goodwill, by the way? Goodwill of Hens company. It should be calculated as 100,000 plus 80,000, netting it off with 105,000, and this would lead you to goodwill of 75,000. All done. So for Kroll company, we have goodwill of 74,000, whereas goodwill of Hens company, we have it 75,000. This is one thing that we have already done it. Yeah. Moving back to the question, guys. Note number 3, by the way, examiner says at the end of 20x6, at the end of 20x6 means this year, the goodwill impairment review revealed a loss of $8,000 in relation to the business combination with Kroll company. The goodwill in Hens company was unimpaired. So no impairment for goodwill on Hens company. There is no goodwill. There is no impairment of goodwill of Hens company. But yes, there is an impairment. There is an impairment of goodwill on Kroll company. And the examiner has determined this impairment of 8,000. So if someone was to ask me what is goodwill of Kroll company after impairment, the balance would be 74,000, netting it off with 8,000. The balance would be 6,000. So basically 66,000 is the value. 66,000 is the value that will be reported in SOFP plus the impairment of goodwill, guys. The impairment of goodwill will be reported as an expense in books. What is the accounting entry for impairment of goodwill, by the way? If it's full goodwill method, goodwill belongs to both parties and therefore impairment also belongs to both parties. So CR will be debit by 80%. NCI will be debit by 20%. So 8,000 will be shared here. Yeah. And then the credit would be of goodwill. 8,000. All right. So this is the accounting entry that you would be actually preparing if you're solving for Kroll company. We have also done note number 3, guys. This is the good part. Now let's move on to note number 4. Examiner says during 20x6, November 20x6, Kroll company sold goods to Dobry company. I can write down note number 4 here. Kroll company, which is subsidiary 1, sold goods to Dobry company, which is parent company. So it is basically an S2P sale. Yeah. Kroll company sold goods to Dobry company for $18,000 at a markup on cost of 20%. Half of these goods were still held by Dobry company at 31st December X6 and the balance payable was still outstanding. See, first of all, you need to calculate URP on inventory. Remember guys, URP is only up to the extent of closing inventory. URP is only up to the extent of closing inventory. So you have an inventory, the total transaction value was 80,000, 18,000, and your examiner says half of these goods were still in inventory. That means multiplied by 50%. So the inventory was 9,000. And if I were to calculate URP on inventory, it was given with a markup of 20%, markup on cost of 20%. So what you should be doing is you should be taking 99,000 divided by 120 multiplied by 20 so that you get URP on inventory in an S2P sale of 1500. What would be the accounting entry? CR NCI debit with their respective proportions and group inventory credit. All right, got this point? So this is the accounting entry that you prepare. Furthermore, guys, it was written the balance payable was still outstanding. You see, Kroll company sold goods to Dobry company. So Dobry company must have had a current liability of full 18,000. You see, examiner says the balance payable is still outstanding. So no payment was made by Dobry company to Kroll company. Yeah. So Dobry company must have had a current liability of 18,000 included in their current liabilities. And likewise, Kroll company would have had an intra-group receivable at their end of $18,000. Now this needs to be knocked off. While we are preparing our SOFP, please make sure that you remember the fact that you need to knock off 18,000 from current assets and 18,000 from current liabilities. These represents intra-group balances. These represents intra-group balances which need to be knocked off. Yeah. Now we have read all the adjustments now, and now for 20 marks you need to prepare consolidated SOFP. For 20 marks you need to prepare consolidated SOFP. How do you do that? Now before you go on to form a consolidated SOFP, I would recommend that you first complete your workings. There are three main things that you always require to prepare. These three things are always required if you want to prepare a consolidated SOFP. And these are goodwill, we have already calculated, CR and NCI. In this question, we'll be preparing consolidated retained earnings. I'll name this workings. First working will be related to consolidated retained earnings. By the way, we will also be preparing one working for consolidated revaluation reserve, because in this question we have consolidated revaluation reserve as well. So how do you prepare this? You need to make columns for each of the companies in this question. There are three companies: Dobry company, then there is Kroll company, then there is Hens company. Yeah. So there are three companies. First of all, you write here retained earnings as per balance sheet or as per question. What are the retained earnings already provided to you? These are 238,000, 80,000 and 32,000. So 238,000, 80,000 and 32,000. All right. These are retained earnings as per balance sheet. Then you would subtract from here less pre-acquisition retained earnings. You will need to less pre-acquisition retained earnings. So now there is no pre-acquisition for your own parent company. There is never a pre-acquisition for your own parent company, but there would be some for Kroll and Hens. For Kroll, I can just link it with here is equals to minus 30,000 is equals to minus, I will also bring, something for Hens company, 16,000. So the post acquisition retained earning would be post-acquisition retained earning is as follows. Then you need to make some adjustments in this. And what will be the adjustments that you need to prepare? Remember, the rule for making adjustments is the relevant adjustment goes to the relevant column. Relevant adjustments goes to the relevant company's column. For example, if I start from the very beginning, remember we had a deferred consideration here on which we had to recognize an unwinding of discount. It is our acquisition, our consideration, so it will bring our consequences. So any unwinding of discount will be taken to parent company's column. I will just write down here unwinding of discount. Where did I calculate unwinding of discount? Oh yeah, here I get it. The unwinding of discount impact was 7,200 and this will be booked in our column. Then what next? What next? If I go back to the question, I have nothing to do here. Oh yes, then in note number 2, with the reference of note number 2, I had some excess depreciation due to fair value adjustment of hence company. So excess depreciation will be booked in the column of hence company. I can write here excess depreciation and this will go into the column of hence company. The value of excess depreciation is this 6,000. Yeah. Then we had some impairment on crawl company. So I will also write down here, guys. I will also write down here some impairment on goodwill. This impairment related to crawl company and we followed full goodwill method. So impairment belongs to both parties. The impairment was 8,000. Yeah, just putting it with a minus sign, making sure that I have relevant impairment expense booked into my accounts. Yeah. Then what next? Oh yes, I have a URP. I have some URP 1500 and this was a sale from crawl company to Dobry company. So URP on an S2P sale. So CR and CI would be adjusted in this column. Yeah. So you know how consolidated retained earning is formed, right? Now, once we are done with all of this, what we can do is make up an underline, calculate the adjusted retained earning for each of the 3 companies is equals to sum, taking post-acquisition retained earning, netting it off with all expenses and all costs. Here we have adjusted retained earning of the following. Then we need to have share of crawl company and share of hence company for the purpose of consolidation. So in crawl company we had a holding of 80%, whereas in hence company we had a holding of 75%. So 40,500 into 80%, 10,000 into 75%. So the consolidated retained earning balance consolidated retained earning balance would be this 270,700. This should be the value. Sir, if we brought 80% of this 40,500 into our retained earnings, consolidated group retained earnings, where would the remaining 20% go? The remaining 20% will be given to NCI. Now, without any further ado, I will also be preparing one working for consolidated revaluation surplus. I'll be following the same format so that it's easier for you to learn. I have 3 companies. Which is Dobry company, crawl company, and hence company. First, I will be writing revaluation as per revaluation surplus as per question. And if I go above the only one company has revaluation surplus, which is Scroll company, and no other company has revaluation surplus. Seems as if they were following the cost model. So 0, 30,000 and 0. Yeah. I will subtract whatever was pre-acquisition reserve. So pre-acquisition reserve on revaluation surplus for Crawl company was 15,000. Very good. And the post revaluation surplus would be 30,000, netting it off with 15,000. We have an answer here. And if we were to record share of Crawl company and share of Hens company, 80% holding in Crawl, 75% holding in Hens. So only 15,000 into 80% would come to us with a value of 12,000. 0 into 75% is technically 0. So the consolidated revaluation surplus for the purpose of reporting into consolidated SOFP would be 0 plus 12,000 plus 0. So the total value of 12,000. All good? This is it. So now we have prepared consolidated retained earning and consolidated revaluation surplus. We also need to prepare NCI. Yeah. NCI is only prepared for subsidiary companies. So we have Crawl company. Yeah. NCI only has holding in our subsidiaries, Crawl company and Hens company. First of all, we will be writing fair value of NCI at acquisition. The fair value of NCI at acquisition for Crawl company was already provided in the question. My friends, you can go above and see in note number 5, the fair value of NCI at acquisition was 39,000. So for Crawl company, I already have it. Can anybody give me a guess? Where will you get the fair value of NCI at acquisition for Hens company? Nothing was pre-provided in the question. Where would you get it? You see, the NCI of Hens company has holding of 25%. If we have 75, they have 25. Where will you get the initial acquisition date value of Hens company's non-controlling interest shareholders? How will you calculate that? It's very easy, by the way. What you will do is, you will go and check out the pre-acquisition reserves, the pre-acquisition net assets of their NCI, of Hens company. So you have $100,000 for share capital and retained earning of $16,000 at the date of acquisition. So the total company's net assets or total company's equity is equal to 116,000. Yeah. And if I were to calculate NCI at the date of acquisition, I can simply multiply this number with 25% and I will get the opening or acquisition date NCI worth, which is of 29,000. All right. Then I will take share of retained earnings and then I will take share of revaluation surplus. So share of retained earnings, Crawl company's non-controlling interest will get 20% of this 40,500. Taking it. Hence, company's non-controlling interest will get 25% of this, because 75% we had consolidated into our retained earning, then 25% would be belonging to NCI. Then we would get revaluation surplus share. So the post revaluation was 15,000. I will take 20% into Crawl and 0 into Hens. And the NCI at balance sheet date would be 31,500 for Hens company and 50,100 for Crawl company. Understood? So what is the total value of NCI that we have? Total value. Total NCI in this particular group, it is 81,600. Yeah. All done? And now what we just need to do is we need to prepare a consolidated SOFP as at 31st December 20x6. And we'll be starting with assets first of all. In assets, we'll be having non-current assets. And if you go above, the first type of non-current assets that you had was property, plant and equipment. 240, 130 and 120. Consolidate as if you own everything. P, P and E. 240 plus 130. You can see the cell workings here. 240 plus 130 plus it was 120. It was 120. Yeah. And do you guys also remember we had a fair value adjustment of 24,000 somewhere here? 24,000 fair value adjustment. This would also be added. Plant debit, goodwill credit. Yeah. And then there was excess depreciation of 6,000. So this would be subtracted. Yeah. So P&L debit and asset credit. So all in all, the property, plant and equipment balance that you will get from here is 508,000. Then what is the next non-current asset that you will bring? You will bring goodwill. Now you have goodwill of two subsidiary companies. I'm just linking it is equals to moving my cursor. Goodwill in Kroll company was 66,000 after impairment, and goodwill in Hens company was 75,000, and there was no impairment. So total goodwill is 141,000, goodwill of 141,000. If I go back again into the balance sheet just to look what needs to be further done, investments would have been knocked off, and then you have current assets 526, 170 and 80. $526, just keep a focus here. 526 plus 170 plus 80,000, and with a minus of 18,000 because intra-group receivables and payables had to be knocked off. So this would be the calculation. 758,000. And further 18,000 would be the intra-group receivable that is being knocked off. And I also need to adjust the URP, the unrealized profit. Remember what was the accounting entry for URP? The accounting entry was CR debit and group inventory credit. CR NCI debit, group inventory credit. So I also need to adjust 1,500 from here. This is 756,500 for the time being. Total assets in this case would be 1,405,500. And then you talk about equity and liabilities. First of all, in equity, you will have ordinary share capital. Then you will have consolidated retained earnings. Then you will have consolidated revaluation surplus. And you will also have NCI. Yeah. So ordinary share capital comes off only parent company, which is 500,000. The rest of the share capitals are always eliminated as a result of consolidation. All intra-group investments and capitals are cancelled. Consolidated retained earning had a total value of 270,700. Consolidated revaluation surplus had a total value of 12,000, whereas the total value of NCI was 81,600. So what is our total equity? Our total equity would be 864,300. And then we talk about liabilities. In liabilities, we have non-current liabilities and current liabilities, but we have got no non-current liabilities in this question. We have only got current liabilities. In current liabilities, the balance is 308, 90,000 and 68,000. So I can easily write current liabilities 308,000 plus 90,000. Look at the formula bar here. 308,000, 90,000. Then you have 68,000. Then you also need to minus out intra-group payable, by Dobry company to Kroll company. It is being cancelled, 448,000. And further, you will also have some deferred consideration. What would be the value of deferred consideration, guys? What would be the value of deferred consideration? The value of deferred consideration would be, what was the value of deferred consideration? The initial liability created was 80,000. And by the end of the year, that liability would have increased by the value of unwinding of discount. So also to include 7,200, the closing balance for deferred consideration liability would have been 87,200. If I were to calculate total equity and liabilities, this would have amounted to 864,300 plus 448 plus 87,200. I'm certainly missing something. The difference is 6,000. What is the value of 6,000 that I'm missing? 6,000. Did I include depreciation in this? Yes, I did include. And anything else which relates to 6,000? All right, so now I know where I had done the mistake. Yeah, I just figured it out. In NCI, remember how did I calculate the fair value of NCI at acquisition? I had taken retained earnings and share capital and multiplied it by 25%. But what I forgot to take was the fair value adjustment that happened at the start of the year. Yeah. So the impact of fair value adjustment also goes to NCI. Obviously. Yeah. So the total balance would have been 87,600 for NCI. And now the question is balanced with the value of this. Yeah. So I hope you understood this question. This was an easy question. I truly expect that you do this question again on your own. This was a very easy question. This should have been done by yourself easily. But nevertheless, I did it for you guys. I hope you liked it. Take care. Allah.